Let's work through some exercises in Chapter 9. This is depreciation and amortization and disposal of these fixed assets or long-term assets. Maybe a little discussion here of the intangible assets as well. Straight line depreciation, the easiest method we can have in this chapter. We had a machine that cost $400,000, and recall that when we say things cost $400,000, that means all the cost to get it into a usable location and condition. The estimated residual value is $40,000. They're going to use straight line, and they're asking us to calculate book value at the end of year 3. Oftentimes students will go to the very last sentence here which says calculate book value at the end of year 3 and try to jump ahead. No, what we need to do is we need to do the setup. And the setup for straight line depreciation is to calculate the depreciable cost, 400,000 minus 40 or 360,000, and then allocation, the allocation ratio, which is 4 years, so 1 over useful life, or 1/4. So the first thing we need to do is this calculation of the straight line formula, which is our setup, and we calculate the amount of depreciation as being 90,000 per year. Now you can do a table, or with straight line it's fairly simple to just know that if it's 90,000 per year, 3 years, 3 times 90,000 is 270,000 in depreciation that's been taken. So the accumulated depreciation is going to be 270,000. If the depreciation is taken as 270,000, and that's taken to date, and the initial cost of the thing is 400,000, have to be a little careful here, because this is not residual. The top one here does not take out residual. It's what we paid for the thing, all the costs going into it. 400,000 minus 270 leaves us 130,000. We could have also been asked what was the book value at the end of year 2, and we would say 220,000. Or the end of year 1, and we would have said 310,000. So before you jump ahead and go to this last line, which is what they're asking us for, you should do the setup, which says come up with the formula, fill in the amounts in the setup, and then if necessary, which you may not need to do it with straight line, go ahead and fill out the table. Then answer the question. Here's one using units of production method. And it's a machine, again 400,000, again residual of 40,000. So we have 360,000 that we need to spread over the useful time period, and this is going to be done based on machine hours. So we're going to base this one on machine hours. So the 360,000 needs to be spread over 20,000 hours, and you could calculate the cost per hour. The formula that the book uses, though, is to set it up cost minus residual value times actual production for the period, which in the first year is 3,000. Second year, this number is going to be 8,000. Last year, 6,000. Over estimated total production, which is 20,000 machine hours. One of the first things you need to do when you're setting this one up is to note whether 3 plus 8 plus 6 is greater than 20,000. If that's the case, you may need to adjust the last year. This is 3 and 8, which is 11. 11 and 6 is 17. So no, we're not at 20,000 machine hours yet. We're going to take the full 6,000 hours and calculate that in our last calculation. So first year, it's 360,000 times 3,000 from up here over 20,000 is 54,000. And again, they're going to ask you what the book value is at end of year 3. You're going to ignore the question. You're going to do the setup. The setup consists of doing the formula and then calculating the depreciation per year. And the depreciation per year is a matter of plugging in the actual machine hours over the total production which we estimate in the beginning. Again, you can see this is 3 and 8, 11 and 7. 11 and 6 is 17,000 cumulative. We would only be concerned about changing the last year if this last year's cumulative amount had been greater than 20,000. When we fill in the schedule on this, we can calculate our book value at any given point in time, and it's going to be 400,000, which is our cost, minus our accumulated depreciation at each one of these points. And accumulated depreciation is depreciation for this year, and then the next second year it's depreciation for the second year plus the first year, or 198,000. For the third year, it's depreciation for all 3 years combined, which is 306,000, and we end up with a 94,000 book value. I believe when we went up here we wanted to have an estimated residuals value of 40,000, so that's another way to tell that we can continue to take into account our machine hours and do the calculation for another year. However, we need to watch it because we need to make sure that we don't take more than how much in fourth year? 3,000 machine hours, because then it will be up to 20,000, and when we take our depreciation expense on that, it will be 54,000, which will get us up to the book value of 40,000. So double declining balance. In double declining balance, we need to understand that in this formula you do not put in residual, you put in accumulated depreciation to date. This is one of those calculations where you must create this chart. If you don't create the chart, you'll be very confused before you get to the end. If it's typically 4 years, then it would be 2 over 4 here for the ratio to apply, which is 1/2, which is a nice number. 400,000, no residual. Instead you take accumulated depreciation, always in double declining. The first year accumulated depreciation will be 0 because no depreciation has been taken. So half of 400,000 will be 200,000 depreciation in the first year. In the second year, you're going to use the depreciation from the first year to calculate what your balance, your book value is, and that's 200,000. 200,000, half of that would be 100,000. And in the third year, you're going through here and you're saying, okay, my accumulated depreciation to date is 200 plus 100, which is 300,000. This is 100,000, 400,000 minus 300,000 times a half of that is 50,000. The cumulative depreciation which you have taken to this date then would be 350,000. Again, we have to watch out. We have to be concerned about our third year if we're taking too much depreciation or not. Helpful, most helpful to create the schedule for this one. Our cumulated depreciation to date is 350,000. Which means at the end of the third year, if we used it, went through and did this calculation, we would have a book value of $50,000. We need to end up with a book value of 40,000. So have we crossed the line? No. We have 50,000 in book value. The 50,000 in book value is greater than the 40,000 that we need to be at, so we are fine so far. Cumulative depreciation at each point in time is the accumulation of the depreciation expense which has been taken on this asset. The first year is only 200, the second is 300, and the last year, the third year, which we show here, is 350,000. Now we are going to do some more problems in depreciation so you get used to working through these schedules, and they're just going to ask us to create a depreciation schedule. Before we do the schedule though, again, you go back to the formula and work through that. They purchase the machine at the beginning of the year, so no partial year to consider here. 22,000, residual is 2,000. We're going to depreciate 20,000 over 5 years when we do straight line. And I think you can calculate that, and that's going to be 4,000 a year. You probably do not have to do this table to get at any number they might ask you. However, the requirement in this question is that you complete the table. So our depreciation expense is going to be $4,000 every year. It's a bit redundant to write the same formula down every year. Our accumulated is adding for each year until we get up to $20,000, and then we have $2,000 left as our book value, which is wonderful because we wanted our residual value at the end to be $2,000, and it is equal to book value, so we've successfully worked our way through this problem for the A straight line. Units of production, we need to be careful here. We want to use up 10,000 units. 2,000, 3,000, 5,000, 2,000 is 7,000. 7,000 and 2,000 is 9,000, and 1,000 is 10,000. Let's check it working through the problem. Exactly 10,000, and how do I know that this is working out fine? Because if we use 10,000, we should come up with a book value which is equal to what our expected residual we wanted to have was, and that was 2,000. So we are fine. Again, 2 and 3 is 5, and 2 and 2 and 1 is 5, so a total of 10,000 here in the numerator, which is equal to the denominator, which is 10,000. So it should work out fine. This amount of depreciation expense, as we said before, is going to change with the level of production or usage, and therefore we can't say that it consistently increases or decreases. It varies with the actual hours, which is the numerator. Double declining balance. The thing to watch here is the book value is going to be book value minus accumulated depreciation, not residual. So in the previous two, we took 2,000 off for our residual. In double declining, we don't take 2,000 off, we take out our book value. And the book value can be found by looking behind at the previous period. So in the first period, it's always going to be 0. In the second period, you're going to pick it up from here. Third period, you're going to pick it up from here. Fourth period, you're going to pick it up from here. And the last period, you would pick it up from there. And you're going to say, but that's not what they did. We'll get to that. You can also find out what the accumulated depreciation is by adding up the depreciation expense at points in time. So this plus this is this, this plus this is this, this plus this is this, and it accumulates. Now, one of the things you're going to see in this is if we did go in here and we did put in our last depreciation, and we use the methodology of putting in this formula, only putting in 19,149 in here times 2/5, we would get a number that would be too great. This number would be so much that when we calculate our accumulated depreciation, this balance in accumulated depreciation would be greater than 20,000. We cannot let the accumulated depreciation get more than 20,000 because we need to have a $2,000 book value. So this minus this needs to be 2,000. And this accumulated depreciation number is coming from the previous accumulated depreciation balance plus the depreciation for this time period. So we need 19,149 plus some number to be 20,000. We plug in the number, it's 851. 851 plus 19,149 is 20,000. 22 minus 20 is 2,000 book value, which is our estimated residual. Okay. Then they ask us, which method will result in the highest net income in year 2? Does this mean that the machine was used more efficiently under a depreciation method? The method that results in the highest net income is the one that reports the lowest depreciation, and this one would be straight line. And when we say net income, it has nothing to do with the usage of the equipment. It is merely a way in which we allocate cost, and this particular method will have the lowest depreciation expense. Sonic purchased and installed electronic payment equipment at their drive-ins at a cost of $27,000. Has the estimated residual of $1,500. The equipment is expected to process 255,000 payments. So when they use production units of production down here and we calculate that, it's going to be based on the actual payments that are processed. And again, our concern here is whether our cumulative amount of payment transactions gets up to 255,000 or not. It cannot go over 255,000, and so we need to watch our last year's calculation or our cumulative payments in this process. Units, straight line, units of production, and double declining. Well, straight line, you hardly need to do anything here because you're going to just take cost of 27,000 minus 1,500, a little tricky math, but you'll get it, and then take times 1/3, and that's 8,500 per year. Every year you'll take 8,500. And this is going to be over 3 years, so at the end of the 3 years you will be left with a book value of $1,500. And there it is scheduled out. If you use units of production method, the units of production, you're going to put the actual production over the estimated production. And we want to get to 255. It might be helpful if you put this in Excel or used a calculator, because you're going to add up this, you're going to add up this, and you're going to add up this, and you need to be careful because you need to make sure that the cumulative total of the numerator here, 61,200 plus 140,250 plus 53,550, does not exceed 255,000. If it does, you may need to adjust your depreciation for the last year. And we go through and we calculate the accumulated depreciation, and if done properly, then we should have a book value. I don't like this undepreciated business. We should have a book value equal to the residual, and we do. Double declining balance, it's cost minus accumulated depreciation. What do we need to watch for here? We need to watch for our total accumulated depreciation, again, not becoming too great, because we want to end up with only the book value as residual. We also need to be careful. In the first year we don't use residual here. We use book value, which is always 0 in the first year. We know that also the rate is going to be twice the straight line, and it's 1/3 for straight line, so it'd be 2/3 here, and calculate that through. The second year you're picking up that depreciation only for the first year. Be careful about this methodology though, because in the third year you're not going to pick up the 6,000 here, you're going to pick up these totals. So for the first year that you pick up this number, second year you're going to pick up, the third year you're going to pick up this and this to get the number here. And this is 18 and then 6 and then 2. And another thing you need to look for is you need to see that the depreciation expense should go down each year when you work through this. If you're working through it properly, it will go down. So this is the initial setup, and we'll put it in a table and we'll see that we come up with the right numbers. When we come up with it doing this way, we notice that our book value is 1,000 in our third year. We don't like that. We want to have 1,500. Does anyone have an idea of how we would fix this? Yes, we go back to the third year and we would change this depreciation expense, and we need to lower that depreciation expense. We need to lower the depreciation expense, and so we end up with the right amount of book value. I'll go back to this slide. I think I believed it would be here and it wasn't. And so if we want to have $1,500 here, what has happened is we have taken $500 in too much depreciation here. We need to reduce this depreciation expense in the last time period. In exercise 9.9, we have FedEx, and FedEx has a fleet of air cargo, and more than 54,000 ground vehicles that pick up and deliver packages. They sold a delivery truck for $16,000. They originally purchased it for $28,000 and had recorded depreciation for 3 years. The wonderful part about this problem is they aren't asking us to go through and calculate our book value. They are telling us what accumulated depreciation is. Some problems you will have to go through, and as in the PowerPoint for this chapter, we calculated what depreciation expense was and therefore got to book value, and then we worked our way through it to determine if we had a gain or loss. They've taken a few of the steps away, so we do a little less work here. They're telling us what accumulated depreciation is under 3 different scenarios. So we may have accumulated depreciation of $12,000, $10,000, or $15,000, and they want us to tell them what the gain or loss is. Again, you can work these problems 2 different ways. You can say, okay, our cost is 28. Cumulative depreciation is 12. Our book value then is 16. If our book value is what we expect to sell it for, and we do sell it for the same amount, we don't have a gain or loss. In case B, our book value is 18,000, and that is what we expected to get out of it. We actually got 16. We lost 2. In example C, we expected to get 13,000. We got 16, so we have a gain of 3. The alternative way to do this is to do the journal entry, in which case you would record a debit to cash of the 16,000. You would record a credit to the cost of the equipment, or removing the equipment, for 28,000. A debit to accumulated depreciation for these amounts across here. And then you would determine, do I need a debit? Do I need a credit to make it work? You would need nothing in the first example. In the second example, you would need a debit of 2,000, so it would be a loss. And in the last example, you would require a credit, which is 3,000, or a gain. The effect on the accounts, I don't find this approach particularly helpful, but there may be some of you that like this analysis approach still, and if you use that, you can work your way through this. Just be careful when you get your accumulated depreciation, because it is a contra asset. We're talking about removing the balance, and normally when we remove balances we credit them, but since it is a contra, it shows up as an increase to the asset. So it gets a little confusing. Therefore, I don't particularly like this approach. A gain or loss reported on disposal is directly affected by the book value of the asset, which is itself affected by the amount of depreciation recorded before disposal. With the same sale price of $16,000, a larger amount of depreciation recorded before disposal results in lower book value and a gain in case 1C. A smaller amount of depreciation results in a higher book value and a loss on disposal in 1B. And so students are sometimes bothered by the fact that depreciation is so much different under all these methods, and it affects the financial statements. But actually, if you take too little depreciation, then your book value is higher, and you will end up not having depreciation expense, but you'll have a greater loss when you dispose of it. So the effect is whether you're going to have an expense showing up over time, or whether you're going to have the loss at the end when you remove the asset. And here again are the journal entries. If you took the journal entry approach to the problem, you would note that you are always getting the same 16,000 debit to cash. You are always getting the equipment credited for its book value. The difference was in the accumulated depreciation that's being removed. Under the three scenarios, the number changes, and because this number changed, we need an additional 2,000 to make this journal entry balance, and it was a loss then because it's a debit. And in the third case, to get up to the amount we needed, we show a gain, and the gain is 3,000.